Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
I am doing really good, Joe. And part of the reason for that is, as you and I were talking this morning, I actually got my kids to go to school today. So it is, we're having a huge debate and big arm wrestling going on this morning, which is okay. So we had spring break here last week. And we go to private school, and, public school spring break is this week, but they're with the kids back at school. They have all these rules about, if you left the state and you went on a spring break trip, out of the state, then you've got to stay home all week. But if you were in state, you can still come to school. They give everybody the, they take their temperature on the way in every morning and all that stuff. But for whatever reason, I have twin girls, Tom. One of my girls felt we should not be going to school this week, because we're worried about the other kids. And I was like, hey, nice play on trying to get out of going to school, because we do homeschool, we do it online if they'd still have to go. But I was like, she's having some intuition that she's worried about these kids getting COVID these days and being at school after everybody's been on spring break. So it was, and I have that concern too. So it was a little interesting debate we had to have this morning. And ultimately, we decided to go ahead and go to school. So I'm free here. That's all I'm saying. I got half a day to myself, enjoying some time this morning with you guys. But that is what's up with me this morning. How about you guys? Joe, where are you at?
I'm in Enumclaw. We just got back a few days ago and switched the snowboards for the mountain bikes and got some cool additions to the van. We added another 21-gallon tank to our van, which is fun. So now we can be out longer with more water. So if anybody wants to check that out, should check out our fantastic life stuff. I just made a video on it. But just chilling, and got our last snowboard day in at Crystal the other day.
Oh, good stuff. I think we got our last day in at Stevens on Friday. Tom, where are you located? We're going to introduce you to our new friend, Tom Laune here, guys. And you guys are going to love this one today. But before we do that, Tom, where are you at?
I'm in Nashville, Tennessee, just south of Nashville, Tennessee. Yeah, it's beautiful weather today, just incredible.
Good stuff. Well, today we are very excited, everyone, to introduce you to Tom Laune, and I'm going to read my notes here. So Tom is an authorized practitioner of the infinite banking concept that has come up in our discussions here in the last month or so. And Tom is the leader of guiding real estate investors to becoming their own banker. And today we're going to talk about how to increase your returns, and also how to increase the control of your money by creating a line of credit using a specially designed life insurance policy that is very popular with smart real estate investors. So I encourage you all to check out Tom's website also at stressfreeplanning.com. Where you can get a lot of other information. I saw you have some videos on there and stuff like that. But welcome, Tom. This is a concept we've never talked about before or covered. We've had a lot of topics here about cross-collateralizing loans with our friends, such as at Flynn Family Lending. We've had a lot of talk about, tax-free investing by using some of your IRAs and some of your retirement accounts to do that. But today is something extra special, and we can't wait for you to fill us in on your expertise in that regard. So we're going to let Joe kick it off so we can get to know you a little bit better as we get started today.
Yeah, absolutely. Great. Tom, we love to get to know not only why people are where they are today, but how they got there. So if you can take us back and let us know how you grew up, where you grew up, we'd love to hear all of that about you.
Awesome. Well, thank you guys so much for having me. And I'm really looking forward to being able to share this concept with you today. So I had a really unique path to getting where I'm at today. And I came from, believe it or not, guys, the music industry. Okay, so here I am in Nashville, Tennessee. And I was in the music industry for 29 years. Okay. And it was really an interesting thing that happened in the music industry. And that is, I had a guy come and tell me, you need to protect your ability to earn a living. And he got me signed up for this thing called disability insurance, which has nothing to do with infinite banking, but it is a part of what I personally do now called the Bulletproof Wealth Strategy, which incorporates multiple different things, and infinite banking is one of them. But what this guy said was, you need to protect yourself to make sure if you're ever not able to do what you're currently doing, then you would still be okay. All right. So that's called disability insurance. And what I was doing, I was actually killing it in the music industry as a mix engineer and music producer. I was working with artists like Bruce Springsteen, REM, Aretha Franklin, the Fabulous Thunderbirds, just a whole host of really big artists at the time. And I was mixing their records and producing. And I ended up doing a ton of this genre called contemporary Christian music, working with people like Amy Grant and Michael W. Smith and Rich Mullins and all these different artists, over 310 of those different artists. So a lot of different stuff over those 29 years. And then one day I was working in the studio and I was actually doing a movie soundtrack. And all of a sudden, I was having trouble with the high frequency in one ear. So you have to be able to obviously hear perfectly to do that job. So I was having trouble hearing just the correct amount of high frequency sounds from one ear. And I was like, hey, I better get this checked out. It turned out that I was experiencing tinnitus and I was having some permanent hearing loss in one ear. And that policy that I purchased 20 years earlier kind of saved my whole thing. You know, it just it protected me just like it was promised to do, where when I wasn't able to do that former job, I was able to then go back to school and do basically anything I wanted. And I had a tax-free monthly income coming in every month for 5 years. So what I did was I went back and got 3 financial designations. I ended up getting a chartered financial consultant designation, a chartered life underwriter designation, and a chartered special needs consultant designation. So all of those 3 designations took about 4 years to complete and consisted of just a series of massive amount of studying and testing and everything. And during that process, I found the infinite banking concept as I was going through every possible financial scenario that existed. Basically through all of these tests and exams, I found out that the traditional financial education system does not teach anything like what I'm doing now. And it's really good to have the broad, knowledge of what is all out there so that I've basically heard of everything, but this is just something they don't talk about. And I had been very interested in a type of economic theory called Austrian economic theory, which there's 3 schools of economic thought: Keynesian, Austrian, and the Chicago School of Economics. And the Austrian economic theory is based on what's called sound money principles. And that is really what infinite banking is all about. That's what it's based on. So that's kind of a little bit of background into how I got to where I am today. But I ended up going through and becoming the very first class of what's called Authorized Infinite Banking Practitioners. So this is going back to 2013 that I went through this program. And it has really been amazing. And the niche that I've gravitated to is working with real estate investors. That's really who I specialize in. And I'm one of the few infinite banking practitioners that really specialize in working specifically with real estate investors. And I love working with real estate investors.
Well, what I have to say about that is we hit the jackpot today, right? While you're telling your story, though, 2 things came to mind. Number one is that like some sort of Oscar for some sound producing thing on your desk there?
Oh, actually, that is an award. It's called a Dove Award, and it's the equivalent of like a Grammy Award for the field that I was in the music industry. It was for producing this artist named Michael W. Smith, who's a big worship leader, and I produced his biggest selling record, co-produced it with him of his whole career. So
Cool.
it was just an award from, it was a while back, but it's good. It's good to have around.
My other thought that came to mind while I was listening was, man, he sure has the ability, like if he wanted to do a commercial, to get some big people to do a little jingle for him, right?
Yes. Yeah. I love that. Yeah, I haven't ever thought of that. I could pull some strings.
That would be hilarious. People like funny stuff, right? Throw it on your YouTube. Have like a contest between all these celebrities to do a little jingle for you about infinite banking. That, it's kind of like, what's that guy, James Corden, who does the karaoke in the car with the celebrities? You could do cool, right? Yeah, well, that's interesting. Well, hopefully I'd be interested to know if any of your music friends and celebrity friends are hitting you up on infinite banking, or how many of them are actually real estate investors on the side. We're going down a rabbit hole we don't need to go down, but
I was involved in a group in Nashville for quite a while called Music and Money, and when COVID hit and everything shut down, we kind of shut it down last year. I'm hoping to get it started back up at some point, but it was really, really cool because it was for people in the music industry who are music professionals who really wanted to find alternative sources of passive income just to normalize or equalize out their income. And so it was a great group, and we had some just amazing speakers come in. We had Brandon Turner come in several times from Hawaii, and just a whole host of great guest speakers come in, and it was just specifically for the music community in Nashville. So it was awesome.
Wow. Well, that is super cool. Well, let's get into it. So you already answered one of my first questions was, do you focus on working with real estate investors, or who else, outside of real estate investors are you working with? We kind of touched on that a little bit. And so I guess I'll kick it off. Here we're used to talking about, or let's go first. Why don't you give us the basics on what infinite banking really is and what it means, and then I'll jump into the questions here.
Well, first of all, let me tell you guys why real estate investors in general have a really good fit with infinite banking. It's because generally real estate investors do not want to give all of their money to somebody else and have that other person control it. And most of everybody in America, in fact, 95% or more of everybody, is completely content with giving their money to an investment advisor to have them invested in something, and then they just hope that they're going to be okay, right? But real estate investors are, in my opinion, a unique breed of people, and they would rather try to seek opportunities and learn what they're doing and control their own investment, and therefore try to have a little bit way more control of their financial future than somebody who's just giving their money to somebody else to do that, to manage it for them. Does that make sense, you guys?
It sure does.
So that's why I ended up working with real estate investors. And honestly, I didn't know that was going to be my niche when I started this. That's just where I ended up gravitating towards. And what the bottom line with infinite banking is that everybody has to put money somewhere or save money somewhere. And there are only so many places you can put money. There's IRAs, there's qualified accounts, there's brokerage accounts, there's checkings and savings accounts. There's a limited place to put money. And this deal with infinite banking is it allows you to put money in a place where it's going to grow and compound over time, but still give you collateralized access to that money when an investment opportunity comes along. So you're not using your liquidity up, meaning you're not using up your access to capital, but you're able to just leave it in a place that's earning you a way, way higher return than a checking or a savings account, but no increased risk. So there's a thing called the risk-free return. And these companies that I work with are, close to 200-year-old companies. The one I really like is 174 years old. And they've never failed to pay a dividend in 174 years, and in my opinion, are way less risky than traditional banks as a place to save money, right? There's just less overall risk because, getting back to Austrian economics for 1 second, they don't employ what's called fractional reserve lending. Have you guys ever heard of fractional reserve lending? No. You never have? Okay, let me just give you a quick update on what that is. So let me ask you a question, guys. If you took $100,000 and went down to your local bank and deposited that $100,000 in cash, how much do you think that local bank could turn around and lend out? What would be your wild guess on that?
Whatever, they have those limits, right? I don't know, 50%? Less?
Good guess. What they do is they take 10% and put it on reserve, and they can employ what's called fractional reserve lending to lend out 10 times what they have on deposit. So if you deposit $100,000 in a bank in cash, they can then lend out $1 million. Okay. So
to
there's
others,
nine
not just
to
me,
to
others.
no,
Yeah.
not to you, to
Yeah.
others.
Right.
So there's $900,000, guys, that, believe it or not, is springing into existence through the magic of fractional reserve lending. And what is the problem with that? The problem with that is that it dilutes the money supply, because anytime you have more money seeking the same amount of goods and services, that is inflationary. Okay. So if you have, $900,000 that just came into existence that wasn't there before, that is just a dilution of the money supply. So that is the magic behind infinite banking, really, is that insurance companies have a 1-to-1 capital reserve ratio. So when you deposit $100,000 with them, or have that in your cash value of your infinite banking policy, they are only able to lend out $100,000. They are not able to take that money and lend it out 10-to-1 like banks are, which makes them inherently less risky. And that is why these old time mutually owned life insurance companies have been around forever, is because they are not employing these risk measurements. Because, as you guys know, anytime you add leverage into a financial system, it also adds risk.
Right.
Okay. That's just a fact of the finance world, right? So what infinite banking is seeking to put money into a whole life insurance policy that is just the opposite of the way everybody normally thinks of doing insurance. So normally, the people are trying to put in the least amount of money possible for the highest amount of death benefit. So they're trying to just get this small premium going in for a large death benefit, and infinite banking just reverses that and puts in the most amount of money as possible that is legally allowed by the IRS code to maintain its status as life insurance for the least amount of life insurance. So it's just reversing the structure of life insurance for the tax advantages and the internal cash accumulation. Does that make sense?
The least amount of insurance benefit.
For the most amount of money. Yeah, you're putting in the most amount of money for the least amount of life insurance. And you're doing that because there's a ton of tax advantages inside of life insurance. It's one of the most tax advantaged financial vehicles out there. And there's a lot of my clients that are phased out of doing anything like a Roth account. So as you guys know, the more money you make, the less chance you have of being able to take advantage of some of these financial vehicles like Roths, for example. There's phase out limits based on how much your income is. And there's also contribution limits, okay? That means that you can only put so much money into those financial vehicles as well, and they're very low. So this is kind of not exactly, but it's similar structure to a Roth in the tax advantages, only there's way higher contribution limits and there's no income phase outs. So
how are the contribution limits, contribution calculated? Like your annual contribution to retirement account is calculated. Is there a calculation or how's that work?
Yeah, there is a calculation, and it's a great question. So what it's based on is each individual person that I work with qualifies for a different amount of life insurance, okay? So if you are 35 years old making $100,000 a year, okay, then you qualify to what's called a 30x income multiple, which means you would qualify for $3 million of life insurance, because the only thing that determines your life insurance eligibility is your age and your income. That determines how much you qualify for. The cost of the insurance is based on your health. So if you're 35, making $100,000 a year, you qualify for $3 million of life insurance. How much that is going to cost premium-wise is going to be determined by how healthy of a 35-year-old you are. And that's largely determined by your height and weight or your body mass index. So if you're healthy, then the cost of insurance is going to be really low. And what we now have established is a $3 million cap on how much life insurance you can own. And then we determined your health, and that will determine your contribution limits. Does that make sense? I know that's kind of complicated, but
what if is it a spot check type of income thing? We're dealing with a lot of self-employed people, and their income bounces around, all over the place. You could have how does that work as far as proving your income, and how often do you have to prove it? Are you like, once you're in, you're good to go, or does the policy expire and you got to renew it every 5 years? And so on that 5th year, you better damn well have your income in the right place, because you got all these collateralized loans out there. And if they call you on your margin, those are the things that I think about, right? Or what if my health changes during, I don't know how long, how does that work? So we'll back it up for a minute.
Wow. It's a bunch of great questions in a row. I love them all. That's good questions. So here's what it is. You only qualify for insurance based on the time of application. What that means is that whatever you're doing and whatever your health is when you apply, that's what you're locked in at. Okay. So if you're making $100,000 a year at age 35, and that's when we apply, then it doesn't matter if you make $50,000 the next year, right? And it doesn't matter if you gain 40 pounds the next year, you're still locked in on your health and your life insurance at the time of application. They never come back and check it again. It's only a snapshot of the application time.
And is that because it's a whole life policy versus a term policy? Or because I feel like my life insurance, he's like, hey, time to renew.
It is.
Right?
Yeah, it is whole life, because it is a whole life policy. That means you're only locking yourself in for the rest of your life. You're never going to have to do another health check. Whereas a term policy really is putting the least amount of money in for the most amount of life insurance. And it's exactly like renting a house versus purchasing a house.
Right.
There's no buildup in equity in term. Okay. So all you're doing is you're taking a snapshot of time and locking in a specific amount of life insurance for a specific dollar amount of premiums. And that is nothing to do with infinite banking. That is definitely something that you do to cover a short-term need.
Right.
Okay. That's what term insurance is.
So my thought, I keep thinking, like, because of this, okay, so we have people listening that are of all ages here, right? We'll put the health thing aside for a minute, but, I guess, is there some strategy involved on when you might pull the trigger on starting this type of thing based on what your future, you don't want to necessarily, do you want to start this when you're making your 100 grand a year? Let's say you've got some momentum going in your business as whatever that is, and you're projected to make more income. You feel confident about that or whatever in the next few years. You don't want to lock yourself in with a limit on, because this ability of this, does the policy amount, the $1 million or the $5 million, have any impact on the whole idea of this as a real estate investor, right? Do you want to hold out a little bit till you get a little bit, so you can get a $3 million policy because your income is anticipated to go up next year? Or is it all based on the cash you're putting in?
Okay, so here's the way it works. That's a good question. And what it is that if you can, right, you can lock yourself in. I have multiple different strategies for people at different income levels. So if you're healthy, it's a good idea to lock your health in with at least a convertible term policy, which is a unique, special kind of term insurance that allows you to convert it to whole life at any time in the period of the term. So the longest lock range on the convertible term policy is 20 years, but you have to have a term policy with a mutually owned company that has all of the features of the whole life that you want in order to have it be viable, right? So locking yourself in with a term policy with for example, a stock-owned company, that would not work because you can't convert it to anything that would work for infinite banking.
Is there a health check on the conversion?
No health check. So you're locking your health in on the conversion. And that is definitely a big part of my Bulletproof Wealth strategy, is for younger investors who don't have the capital to put in right now. I lock them in with a convertible term policy so they're guaranteeing their health is not going to change in the future. It's really cool. And I call it an option strategy. It's kind of like you see an apartment building that you love and you would like to purchase, and you're not able to fully capitalize it yet, but you put an option to purchase it in the future. And that's what this convertible term insurance is like.
Right.
Yeah, it works great for people.
Right. Because you're having to balance, I'd say the leading indicator of the whole thing is going to be almost health, right? As your trigger pull.
It is. So if you're healthy now, I would go ahead and get it. And just so you guys, I don't want to be mean, but in reality, I've been doing this a long time. Most people don't get healthier over time, even though they think they're going to. They're like, well, I'm not that healthy now, but if I just, next year I'm going to be way healthier. Usually it goes the other direction. Okay.
Unless
usually
you're hanging out with Joe, who is going to help your health insurance, right?
Oh, yes. So anyways, that's kind of what I do, is I lock people in with a convertible term if they're healthy and they don't have like a big contribution to put in. But if they are, have a contribution, they want to put it in, then I go ahead and go with the whole life. And then a lot of times I do a combination of the two. So we do some convertible term and some whole life to get it to where it works out, well for them. So it's really a wide range of stuff that I do for people. My Bulletproof Wealth strategy is made up of three things: disability insurance, like I had, which is so important to protect your income; option strategy, convertible term, and then an infinite banking policy. So those three elements are the three legs to the stool that I call the Bulletproof Wealth strategy. And
how about, is there a fourth leg called long-term healthcare insurance?
Yeah, so I don't personally do long-term healthcare, but I will tell you this, that the whole life insurance that I have has a chronic illness benefit rider that works very similar, although it's not exactly the same as long-term care. It works very similar in that you can accelerate your death benefit should you need long-term care. Like, for example, if you had a $6 million life insurance policy, you can accelerate, I believe it's up to $240,000 a year off of that death benefit, not your cash value, the death benefit early in the case of a need for long-term care type coverage. It's really cool. And it has not been working well in the state of Florida because you could only access it for 1 year, but that just changed a couple of weeks ago, and Florida now has the same chronic illness benefit rider as the rest of the country. So I'm super excited about that.
All right. We have some Florida friends, so they'll be happy to hear that.
Yeah.
Let's jump into it. Let's go over like an example of, we'll just go with, wow, that was exciting.
Yeah.
Yeah, my God. Sorry about that, guys. Let's see. How I was saying earlier, Tom, is that our audience will forgive us for anything. I don't know what happened there. All of a sudden just zapped out my computer. So.
Well, I'm glad it happened to you and not me.
I am back. Yeah. Yeah. All right. Well, I share computers with my kids, and so sometimes weird stuff happens. So let's get back to it. Sorry, guys. We're back at it. We're about to talk about an example, unless you guys covered that while I was gone.
No, that's good. I just pulled up an example, so that way I can kind of give you a little bit of framework for this. So the example that I was going to use is a 35-year-old making $100,000 a year. For example, based on that $3 million of qualifying life insurance, I have 3 ways to structure money going into that policy. First of all, you have a have to portion, and then you also have a want to portion. And the want to portion is optional every year. So you can put that money in if you have it available. This gives my customers and clients a lot of flexibility in how they make contributions. So given an example of what I call a hybrid policy design, which is the most popular one, that's allowing you to do an extra lump sum deposit the first year. And then every year after that, there's a lower amount of money that you can put in. So let's just give an example on a 35-year-old. And I don't want to do a ton of numbers because on a podcast format, that's a little rough, but I could, eventually do like a live presentation to your people or something with actual screens and numbers. But for example, on a 35-year-old making $100,000 a year, they would be allowed the first year to put in up to $63,025. That would be the maximum contribution they could make the first year. And then what that would give them is an estimated cash value of $42,273 that they would be able to access 90% of that after 30 days. I know I just said a mouthful, but basically year one, you've got a loan to value of 90%, access to whatever's in your cash value you can get out as a collateralized loan against that cash value. And then the loan to value goes up to 95% starting the second year. So you have a higher loan to value or amount you can get out starting the second year. So
is the 42,000 90% of the 6325?
No, the 42,273 is the cash value that is generated on a deposit of 63,025. And this is just based on a 35-year-old making 100,000 a year, right? So this creates a $3 million whole life policy, all right? So there's this immediate life insurance of $3 million that you have that is in force, basically, right? So what would be accessible after 90 days would be $38,046. So basically you have a liquidity drop between the 63 and the 38. So you don't have every penny that you put in available to borrow against immediately. You eventually have more than you put in. It just takes time because it's also life insurance. So you're building equity, right? It's kind of like buying a house. You have equity when you start, depending on how much you put in. And then eventually the house gets paid off and you have 100% equity, right? And then eventually if the house goes up in value, you have more equity than you ever put in the first place. The difference is this is guaranteed to go up in value. So on this hybrid design, year 2, you're only allowed to put in $33,125. So you do this large lump sum extra money the first year, and then it backs down your max contribution limit backs down to 33,000. And out of that 33,000, 12,086 of that is optional. So what is required on this is around 21. That's what is required to keep it going every year. And that money also goes eventually into your cash value, but that optional money builds your cash value even quicker. So I have, by the way, this is all in a video that is called I believe it was for a multifamily event I did called Multifamily War Room. And it's available on my website, stressfreeplanning.com. You can just sign up. Lots of free training videos that I do at the different events that I go and speak at around the country. I create these videos to educate people on how this works so that they can really understand it. And these numbers are all there as well if you want to dive into this. But again, this whole thing is about where are you putting money? And really, there is no better place in terms of advantages and, that I have found, because you are creating your own privatized bank. Okay.
Right.
And that's the goal of what this is. So no one can tell you can't have access to it. You have guaranteed access to it because there's not another third party that is saying, hey, you have to prove your income to be able to access this money, or you have to prove, that you're healthy. No, you only do it once, and then you build this privatized bank up over time, and you can then access it whenever you need to for any reason. College funding, any kind of real estate investments, there's the sky's the limit on what you can do with it.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show.
Yeah. So let's keep going with like a real estate example then. So, this is, so the access, where we're talking about, I don't want to use the word borrow, but we're talking about collateralizing real estate transactions with your policy here. How does that work?
So normally the way people do it is that they get a traditional bank loan for whatever they can get, and they use this money as their down payment. So if they were buying I don't know, let's just call it $1 million real estate purchase, and they needed to have $200,000 of down payment, this is a great place to get the down payment from. Right? You're still getting an 80% loan on the purchase, but you pull this money for down payment, or we can scale that back to whatever numbers you want to use. But this money is very unique in that you can use it for down payments. You can use it for anything rather than having to pull money out of a checking or savings account for your down payment where you never have access to it again. right? Until you sell that property.
It continues to grow in value.
Yep.
It's not like you're actually physically, when you have your money in the bank, you're physically pulling your money out of the bank, and now you're putting it in whatever. I don't want to call it like a margin. We did a podcast recently about using your RSUs to invest in real estate, and how you can, if you work at Amazon or Microsoft or some of these tech companies that pay these RSUs, that you can use your RSUs to essentially borrow against without cashing them out. So they continue to keep growing in value without, you're just, to me, it feels like it's a margin type thing. Does that make sense to you?
Totally. It's very much like that. You're not pulling it out, and therefore it does still earn a dividend inside the policy. And there's an amazing arbitrage that happens over time, where as the cash value grows inside of these policies, they earn a dividend on the entire cash balance. So if you end up with, for example, $500,000 of cash value in a policy, it's going to be paying you dividends on that. And if you took a $50,000 loan, you're going to pay interest on the $50,000, but getting dividends on $500,000. So there's, just
what kind
a
of
very
dividend
unique
payment is that? Is that able to be translated into
a percentage?
1%? Yeah.
Yeah. So dividend payments are one of the more complex. I did a whole video on this as well, on how dividends work, but there's 3 elements to a dividend. It's a return of profit of the company. And one element is a dividend crediting rate, which they declare once a year. So for example, one of the companies that I use all the time this year, their dividend crediting rate was 5.75%, but that's only one element of the dividend. They have to also take company expenses and mortality charges into account. So the net dividend is usually less than the dividend crediting rate. I know it sounds complicated.
Right.
It is a little complicated.
The net benefit to your return is different than the published rate because there's some fees involved.
Exactly. It's not really fees. It's more like expenses that the company has to be operational.
Gotcha.
Right? They have to do mortality charges, which means they have to pay all of the death claims that people are buying life insurance for. That's one of the expenses. And the other expense is just their operating overhead, right? But they also are returning a ton of capital because you literally are a co-owner of the company when you own a mutually owned policy. So they're returning the profit of the company back to the policy owners. It's really a cool thing the way it works. And the best thing is that it is not taxed because of the IRS classification of a dividend in life insurance, right? It's technically, believe it or not, it's classified as a return of premium. So they're classifying dividends as a return of premium, but in reality, you end up with way more cash value in these policies than any amount of premium you ever have put in. So, you do the math on that.
There's no idea on that, because the dividends start to grow your cash value by so much, right? It's like you said, it's like a tax-free, it's almost like a Roth in some ways, even though you can qualify for this one if your health is okay, I guess. And it grows and it grows and it grows over time. But then I guess if you're borrowing your cash value out, there's going to be some type of interest or some type of payment related to that. What's the story on that? Because people say the easy way, that the go-to that most people would say is, I'm borrowing my own money and paying myself back, is like where your mind goes.
I know your mind goes there. The reality is that couldn't be further from the truth. Yeah, you're not borrowing your own money and you're not paying yourself back. And that is how this whole strategy gets confused in people's minds, is when they start thinking that, right? They're borrowing the insurance company's money and they're paying the insurance company back. And the insurance company you're paying them interest. Okay. So let's just use numbers. I think it makes more
from the insurance company.
Yes. So let's just use numbers. $100,000 loan at 5% interest would be a $5,000 after 12 months interest payment to the insurance company. Okay. So you're paying the insurance company $5,000 for the use of $100,000 of their money, right? For a year. Now, that $5,000 is considered what to the company? That is considered profit to the company.
Okay.
What are they required to do with the profit?
Right.
They're required to return a portion of the profit minus their company expenses and mortality charges back to the policyholders in the form of a dividend. So that's technically what's going on. And it's too difficult for a lot of people to understand. So they just say, you're borrowing from yourself and paying yourself back. And that's just ridiculous because that's not what's really happening. Okay. It's a little bit more complex than that. But when you understand it, it all just clicks into place. And it's like, oh yeah, now I get what's really happening here.
Well, I'm at eXp Realty. I'm a real estate broker as well as an investor. And it feels, I keep thinking like, man, this feels like eXp kind of like it has nothing to do with it, but it's just crossing my mind. Okay, so then
I got to comment on that real quick. A good buddy of mine's eXp as well. Their stock just blew up. What was it last September?
I know it blew up to like, well, I don't think we can talk about that. Let's not talk. I don't know what the rules are. I mean, talking about the stock.
Okay.
I don't want to, but
okay.
If anybody wants to know, the answer is yes. But I don't want to go there because I'm not sure what my rules are on this is public. So
compliance alert.
Yeah,
I get it.
I don't want to go there. So but please, you guys, there are some super, if you want to learn about eXp, call me. So back to this. So, I'm making a payment. What are the terms though? Like, is this best for, related to real estate, right? There's terms. How long can you take this money out?
Here's the
is it
thing
best for short-term use, like a flip, or can you do buy and hold type of stuff, or what's the scoop on that?
Well, believe it or not, and this is, again, another thing that is so hard for people to get their head around, and that is that because this essentially is a privatized bank that you're setting up, that you dictate the terms, right? And what that means, the way that I describe it is unstructured repayment terms. So if you take a loan, no one is going to come after you and say you owe this much interest, okay? It's just going to accrue. Now, what happens is that everybody knows that everybody has to pass away someday, okay? So you have this huge pool of money that is going to be generated when you pass away. And if you have a giant loan, that loan is going to be paid off before your beneficiaries get the balance. So let's just make it simple numbers. A $4 million death benefit with a $1 million outstanding loan is going to net your beneficiaries $3 million. See what I'm saying?
Yes.
So they're going to pay back the loan first and then pay out whatever the net is to your beneficiary of your life insurance policy. And because you have this giant pool of money that is guaranteed by the life insurance company to be paid out someday, then they're able to be a lot more forgiving on the loan terms. You can let it roll over if you want, right? So the terms is that there is no terms. It's unstructured. So I have people say, hey, I would like to pay back $400 a month on this loan. And so we can set them up to have a draft where it pays it back at whatever number they're comfortable with. And I have people who do fix and flipping who want to take a loan and then they don't want to pay any interest or anything until that flip sells. And then they pay it all back at once, which is why real estate investors love this.
And let me add some sauce on top. Like you said, investors can get their first loans, which you're talking about. People are using this for the equity portion they need to close their loans, usually not the entire. I mean, I guess if you're balanced, if you had enough value in there, you could buy a whole thing without, and just go straight for the whole thing, right?
100%.
Right?
Yes,
but let's just say the average person is going to go get whatever type of either private money or hard money loan in first position. The issue always is, hey, I'm short on the equity to close. I'd like to get somebody in second position, right? And what happens is that is limited typically by the loan to value, right? Even our best friends, we love Flynn Family Lending. They'll cross collateralize, they'll do second lien position loans, but it's going to be based on that loan to value, right? There is no loan to value issue here. You're not capping you're creating your ability to put that equity in without any restraints at a cheaper rate than you'd be able to get through a company like Flynn Family Lending that's going to charge you 12% for that money, right? They're not. They're investors. Their lenders are, right?
Exactly. So if this money has, collateralized access at 5%, okay?
Right.
And the thing about it is,
but at the same time, you're getting paid your dividend to offset that, and you don't have to make a payment, right? And there's some value, necessarily until your deal sells or whatever. Boy,
not to blow everybody's mind, but hard money lenders love putting money here. Then they arbitrage the spread where they loan money out at 12% and then they pay the insurance company 5%. What are they making on that deal? I can tell you right now, it's over a 100% rate of return.
Right.
So this is the whole key that I think that we can now get into is how do you boost returns by doing this? Okay. And how you boost returns is I just did a lending deal where, okay, this is all ties into what you're talking about because it was a second lien on a ARV of $755,000 was the after repair value of a house. And the guy, there was a first lien position on it of only $100,000. And the investor came to me and said, I need $125,000 to make this deal work, right? I need additional liquidity dumped in for me to be able to fix this house up because I got a great house on a great, price. And I just need a little bit of extra capital. So I structured the deal where I gave the guy $125,000 for 3 points down and 1 point per month, right? Which for 12 months, that averages to be 15%. Now, I know that everybody structures these deals differently, but I go through this numbers and all in my video on my website, but I can do it, again, but the way it works is that I'm paying the insurance company $6,250 for the whole year, and I'm making $18,750. Okay. So I took what would have been a 15% return had I done it with my own capital, and I turned it into a 200% rate of return because I didn't use any of my own money. I used the insurance company's money to fund that. Does that make sense?
Yes. Are you able to, I guess it's up to the person. I think about things like substitution of collateral. So let's say that it's attached to one property and instead of paying it back, you just substitute it for another property. It's like a substitution of collateral clause. Does that make any sense to you, what I'm saying there? You move it around?
It does, but you can only, so let's just, again, I don't like to confuse anyone, and the way that I try to keep it simple is by using numbers. So let's say you use $100,000. Let's say you have $300,000 of cash value and you take a loan for $100,000. Now that money is in the free world. You have it in some other account. Okay. It's got to be in a bank account or somewhere. You put it into whatever you want to put it into, right? And then you eventually make money on that money, and then you pay it back to pay down the loan again, which it's just like an equity line. Then you can access it again once you paid it down. You can just get it in and out and in and out and use it however many times that you need to use it. And by the way, the access is 5 days by an ACH or direct transfer and 7 days by check. So it's about a week to 7 days to get money out. And then of course you can just directly, pay back any loans with a direct deposit.
So there's no paperwork between the insurance company and you, right? They're not attaching to anything because they're going to be knocking that off of your death benefit proceeds if something goes wrong and it doesn't get paid back. They're not actually attaching to the real estate, which I think when we got started here, I thought, they're going to attach and there's going to be some deed of trust. Nothing, because it's all, if you fail, it's coming off your death benefit.
Exactly. There's no attachment with the deed of trust or nothing like that. This is strictly using the equity in your life insurance as the collateral. They do not care what you put it in. You could take that loan and go on a trip to Hawaii for a month and they don't care. But the reality is that I don't recommend that. I recommend putting it in something that is earning you a greater return than you have to pay back in interest. That's where you get the big spreads. Okay. Right. That's how this really works. But there's nothing that's attached. There's no collateral assignment. There's no nothing. And in terms of the paperwork, if it's a loan greater than $50,000, there's a 2-page document that you have to do, which, because this is all I do and all I specialize in, my investors are taking loans every day, and I have somebody who handles that for us that does, one of my team members takes and does the loan paperwork for you, and we just shoot you a DocuSign. You just click a button, sign it, and then the money's coming your way. So we make it simple. Yeah. Because we know that's who we're dealing with.
My mind is working like this. So I'm thinking, okay, I'm sitting here listening to this and I'm one of the podcast listeners. I'm like, okay, well, I have to have cash to put in there. So, but the point is once you have the cash to put in there, that cash is going to grow for you. Where it's somebody's like, well, if I'm having to put the cash in anyway, then what's the point? I'm having to use my cash to build this policy. Well, the difference in the point is that it's going to grow for you. Plus you're attaching a death benefit, some huge death benefit to it, right? You get where people are being like, wait a minute, I have to spend my money anyway, my cash.
So I totally understand that. And the thing about it is that eventually you have more money in your policy than you ever put in. If you start young enough, you usually end up with double or more money inside the policy is greater than your cumulative premium outlay, usually by a multiple of 2, depending on how early you started your contributions.
Yeah.
So you usually, it grows inside of there.
Because one, if you systematically do this over time, one, you can put more money into it than your retirement account. 2,
yes,
right? Number 2, there's a death benefit attached to just putting your money in a different account, such AKA your insurance policy, right? That's why you want to do it. Number 3, like you said, it's going to grow over time. Number 4, it's like you keep going here. I'm just, this is me getting to know this today, just going through my own process that I think everybody else is going to go through on this. You're not actually having to use your cash, essentially, where you're cashing it out. You're essentially, I don't want to use the word margin, but
no, you're collateralizing it. You're collateralizing
actually cashing it in. So it can continue. So in a normal situation, you're going to use your cash for your equity. It's gone. It's not growing. That's just sitting in the investment you made, making a return. This is like making a return 2 ways while you're using that money. The return on the investment and the return you're going to continue to get because your policy dividends are going to continue to pay while that money's invested. That's the point. Plus this death benefit.
Point. Yes.
You guys get
a lot of people. Yeah, that is it. You did a great job of encapsulating it. Now, stuff we haven't gotten to yet is that I also structure these policies for literally a tax-free retirement income. So at some point, And the way that I normally structure them is at age 68, which is most people's full retirement age, you cannot put any more money in. So I shut off the ability to put in money, and then magically we reverse it like a reverse mortgage, and you start getting a tax-free retirement income every year for the rest of your life. Now, I can structure these.
Because you don't need your death benefit necessarily as you get
not
older.
when you're, yes, that's correct.
Right? Yes.
So in the, guys, this is a little bit mind-blowing when you realize how this works. But just like you said, as you age, you tend to need less and less life insurance. And so we kind of use it up in retirement. Like you might still end up with a $1 million, death benefit at the very end, but you might have peaked at 6 million somewhere at age 67, and then it just goes down over time. But now your kids are all grown, they're gone. It gives you a permission to spend your money that you've worked so hard to save your whole life, still knowing that if something happens to you, you're going to leave some legacy. But, if you live a really long time, then you just keep leaving less and less and less legacy, but it's still cool.
How long is the interest rate that you're paying the insurance company fixed for?
So they declare the interest rate on Jan 1 of each year, and the floor is 5%, and it's been at the floor since 2012. So this is the magic of this, guys. Back in 2009, when the equity markets literally seized up and the credit markets, there was nobody who had access to money, right? The value of everything just went through the floor because nobody could get a loan, right? This company, because you have guaranteed collateralized access, you were at a little bit higher rate than it is today. It was at 5 3/4 in 2009, but you could buy assets for pennies on the dollar. So the thing is that my whole slogan is grow your wealth and avoid lost opportunity, because opportunity cost is something that people don't generally think about. But what it means is that you have access to money when nobody else does. Therefore, you can scoop up amazing deals. Right now, the housing market, the real estate market is on fire. Okay. There's no two other ways to put it. It's just going crazy. There's no way that's going to be sustainable, in my humble opinion. At some point, we are going to see that reverse, and it's going to reverse when the equity markets can no longer sustain it. Okay. So that is, when you're going to want to have access to that capital. And that is what this provides, is a place to save money with guaranteed collateralized access no matter what.
And it's guaranteed collateralized access because it's attached to your death benefit that's collateralizing it, right?
It's attached to your death benefit in terms of paying it back, and the equity in your policy is the cash value. So let me give you an idea. If you had $500,000 of equity in your policy, you could shut the whole policy down and say, give me my equity back, and they'll just send you a check for $500,000. It's your money, but it's got tax advantages by being inside the life insurance policy, in that the accumulation grows tax advantaged. And if you do it right in retirement, it comes out tax free. And by doing it right, what I mean is that we surrender the basis first, which means your accumulated contributions. And then once your basis is extinguished, I switch to collateralized loans only after your basis is extinguished. And then we do collateralized loans all the way as long as you want to. And those loans never get paid back. We use the death benefit to pay them back.
Whoa. Yeah.
That's it.
What is the risk? Is there any risk in all this, or?
So
through my head.
Yeah, it's a good question. So there is, with the company that I really like, I'm just going to say the name of the company I really like is Penn Mutual. It's really has a unique structure to be able to do this. they have a unique feature that no other whole life company that I'm aware of has, and it's called an overloan protection benefit rider. And it is something that I add to every one of these specially designed life insurance policies that I do for people. And what it means is that in retirement, when you are getting older and you're accumulating these massive loans, right? Sometimes the loans end up to be, well over $5 million, then all that is essentially is capital gains inside your policy. Okay. So what this overloan protection benefit rider does is after you've hit 75 years old and your policy's been in force for 15 years. So those are the two requirements, right? You have to be older and your policy has to have been in force for a while, then it can no longer be overloaned. No matter how many loans you pull, they're going to cap it and say, all right, you can't take any more loans, but the policy is never going to lapse, okay? And what that means is that there's no way this could come back to you as taxable income. With other companies, the reason I don't use them myself personally as much is sometimes you have to, depending on what your status is. But the reason I don't use them as much is because if you have an outstanding loan of $5 million and then your policy lapses, that $5 million could come back to you as taxable income in 1 year. And that would mean you would get like a 40% hit on owing taxes on $5 million, which would be awful. That would just about wipe out anybody. So I do everything possible to mitigate any potential risk in the future. And it would be when you're older is when the risk comes in, right? And that is why, believe me, I've thought around this a million different ways, trying to figure out how to mitigate risk. I couldn't call my strategy Bulletproof Wealth if there was a big amount of risk in it. I'll tell you right now, that would be just not possible. The risk comes in what you choose to invest in. So if you pull a collateralized loan for $1 million and put it into an apartment complex, and then the market falls out from underneath you and you don't get the rent increases that you thought, and the whole thing collapses, right? That is your risk. It's what you invest in. Your risk is not with the life insurance. It's going to continue to be there. It's like a savings account. It's similar to that.
So
does that make sense?
Yeah, it's just like you'll get foreclosed on, right? There's no risk of some foreclosure trying to attach to your life. You know what I mean?
No, and not only that, that brings up a whole nother thing, and that is that it's based and regulated on a state-by-state basis, but in most states, and I go through this with people one-on-one to show what their state is when I'm on a specific call with them, your cash value is creditor and predator protected, meaning that it cannot be attached in a bankruptcy even.
Okay.
So if you go bankrupt and you had $1 million in your cash value, in most states, I will say notable exception is California. They have a $15,167 cap on the creditor protection in California, but in most states it's unlimited, and it's really cool. It's just an unbelievably bulletproof place to put money.
But this money that you're going to be putting in is, we don't want people to get too excited and throw all their money in there. This has to be your excess money. You got to keep your money in order to live, right? Because you're not going to put does that make sense?
Yes. You're not putting every penny you make in here. There's no question about it. You're putting, as much as you can reasonably afford that you want to invest in the future. Because
you can't take it out without paying the 5% or whatever, right?
You can take it out via surrenders up to basis without paying 5%, but you wouldn't want to do that because you're going to give up your dividends if you do that, right? Yeah. The net result of this is that you end up getting hopefully more dividends than you pay in interest.
Right.
But it takes time to do that.
Your gain
momentum.
If you were to cash out to your basis.
Right. You lose momentum for sure.
Right.
Yes.
Right. So what happens once you're in there? Let's say you've established your policy, and maybe we already covered this real quick. Then we'll start wrapping it down here.
Sure.
And once you have it established and you've got, let's say, $1 million policy, or it sounds like you can get a lot more quite easily if you're healthy.
Yes.
And you don't make an annual premium payment,
Yep.
what happens?
So
We're self-employed people. People are going to
yeah,
have a
no.
bad year because they're using their earned income to make the premium payment. What if they don't have the excess money to make the premium payment to keep it going?
Okay, so here's what you're asking. Okay, you're asking about a thing called non-forfeiture options, and what the deal is with that is that you don't want to forfeit your life insurance, right? But you want options to keep it in force. All right, so there's about 5 non-forfeiture options. One of them is that you can take the dividend and use that to make the minimum premium payment. So they call that the dividend offset method. Another one is called a reduced paid up election, RPE, reduced paid up election. And what that means is that you're saying to the insurance company, I never want to put in any more money again. Just stop my ability to put in any more money and let the cash value compound and accumulate and give me collateralized access, but reduce my death benefit. Okay. So in order to do the reduced paid up election, you have to have made at least 7 premium payments for the IRS to consider this life insurance. Okay.
Mm-hmm.
A third non-forfeiture option is you can take a collateralized loan from your cash position, cash value in your policy, and use that to pay your minimum required payment for the following year. So you can always take a year off. And that finally, I always build this with a minimum and a maximum. So you're only required to put in the minimum anyway. But if you can't even do that, we can offset part of the minimum with a dividend. We can take a collateralized loan to pay the dividend, or you can stop paying altogether. However, that's a permanent election, and I don't recommend that unless you're really ready to retire early or something like that.
So there's all kinds of ways to deal with that issue. When you say you need to make the 7 payments, my first thought was, well, can I make 7 monthly payments? Like, can I pay it monthly and I do 7 annual payments, right?
So yeah, it's not a monthly test, unfortunately. It's called the modified endowment contract, or the 7-pay test, right? And let me just give you the real quick background.
Investors always looking for the cheapest way to deal with, or the sneaky ways to do things, right?
I got you, man. Well, listen, the government's been around the block on this, and prior to 1986, you could put in $1 million and immediately have it protected from ever being paid tax on again. And they said, hold on a second. This seems way too much like a tax shelter and an investment and not enough like life insurance. So let's just say prior to 1986, you could drop in $700,000 into a contract and be done with it. That was called a single premium whole life policy. And you just put one lump sum in. After 1986, they said, nope, we're going to run it through what we call a 7-pay test. And that means that now you have to make 7 $100,000 equal payments for 7 years in order for it to pass the MEC testing rules so that it maintains its status as life insurance. So no, it's not. You can contribute money monthly, but it's not 7 months. That's not going to do anything. It has to be for 7 years.
Yeah. My other thought is, boy, everybody should build this as part of their entire portfolio, right? If you're, depending on your age, whatever your age is, you might be working with your financial advisor, right? Relying on those other people. But let's say you are, and you might have a portion of your pie of your portfolio that is conservative, I'd say, right? Where you're not swinging for the fences and you're going for a 5% return. Why not do it through this instead of, which is much better for you?
I'll give you a quick example, Julie, is that normally people put around 30% of their income in if they can swing that. So let's just say, for example, somebody making $200,000 a year, we would structure it to where their cap would be around $60K, right? But their floor is going to be much lower than that, the required amount that they can put in. But here's the other thing it does as a side bonus is that it gives people a goal to shoot for so that they know next, April 20th, I'm going to be able to put in that $60,000. So I'm going to start saving it in different places during the year so that I know I can drop that in. And then people eventually just start building that into the way that they do their life, and they save money because they have this goal now to shoot for, to be able to deposit this money into their policy once a year.
And
That's what I do.
There's no ability. You just want to verify, like every year, my CPA says, okay, you can contribute this amount, right? Let's call it 50,000 or whatever the number is.
Yes.
I have to put that into with my, retirement accounts. I can't alternatively choose to put it in something like this. That wouldn't qualify as an alternative to that, would it?
It's not qualified. This money is not qualified, right? It's after tax contributions that grow tax advantaged, and it's unqualified money. So that means that you can then use it once it's in there for anything. With qualified money, now you're under the thumb of making sure that you follow all the rules for distribution. And, it's just, I don't love that, to be honest with you.
I hear what you're saying. Yeah, my initial thought was, okay, well, what if your health changes down the road? But there isn't. It's a snapshot.
It doesn't matter.
So everybody get out there and do that, right?
Yes.
We're going to start winding it down here.
Cool.
I forgot to send my kids with lunch today, and I got to go bring them their lunch. But boy, this is exciting stuff. Boy, I'm sure we're going to try and twist Tom's arm to join us on a Thursday sometime in our weekly meetup for you guys that are going to have additional questions. And in addition, I did not forget, guys, for those of you who would like to go more in depth with this and get it a little bit more in your face on paper, if you are one of those people that likes to follow along with slides, Tom has offered to come back and do more of a webinar with a little bit more detail on all the numbers and the slides. And if you think that's something that you would like us to do and host with Tom, drop it below here on the comments and let us know. We're going to have a vote. And if you guys vote for Tom to come back, sorry, Tom, we're a democracy here. Then
no
he will
problem.
come back and we will do a webinar slideshow with Tom on more details on this topic of infinite banking. You all need to know about it because you don't know what you don't know. And you're probably all thinking, oh man, I don't, how much money do I need to get started? Like, what's like a bottom line number of cash that somebody would get started? Just to give them a little teaser before they drop their comments below to tell us they want the details in a webinar.
Well, I mean, people can start with the convertible term, and that could be just a couple $1,000s a year and max out how much life insurance they qualify for. Typically, though, to start a whole life policy, usually the minimum contribution is in the $20K range, somewhere around that. So it doesn't have to be a massive amount, but if you don't have at least 20 extra money saved up somewhere, then I would say start with convertible term and hold off until you get to that point where you have enough to be able to really make this meaningful.
Right. There you go, guys. And we're going to cover that all on this webinar. We can talk more about that. Super, very awesome. It's funny that out of all these years, I mean, it's been sprinkled here. I've heard about it here and there, and people have mentioned it here and there. But it is interesting that it hasn't been talked about. I don't know anybody that's, I know Brandon, you've had Brandon out and all that stuff, and maybe I'm not looking deep enough on the Bigger Pockets stuff. Have you done a Bigger Pockets podcast?
I have not, and I would love to do that, but I haven't done a Bigger Pockets podcast. Yeah, I need to do
the first. We are we're not your first podcast, but we beat.
No.
Hi, Brandon. We beat you to the punch, right? So, well, that's super awesome. Well, we're going to twist your arm, Tom. We'll give you the details on maybe trying to get you to join us on a Thursday too. Whenever you can. That would be
wonderful.
At the same time every week, and that's Thursdays from 11:30 to 12:30 here Pacific time. It's just a Zoom access link that doesn't change. Joe will send it to you, and you can put it in your calendar and join us when you can. I think people will be super excited to hear more from you. Where you're now officially, you're going to have to be one of our buddies here going forward.
I love it. I would love to join you guys.
So again, you guys comment below if you'd like to get that webinar, if you'd like to, and we'll make sure if you're not on our Seattle Investors Club or our podcast contact list, that we make sure we get that information and get you signed up to, be a part of that webinar that we will hopefully be doing, if you tell us to, with Tom. Other than that, I don't know. I'm ready to wrap it up here, Joe, so I can get off to school with these lunches. What are the details of today's podcast? How can everybody join us? Hey, and shout out to Certain Lending, our friends at Certain Lending, who may very well, we're going to introduce you, Tom. That's our gift to you today. We're going to introduce you to our favorite hard money lenders, which are Certain Lending. If you guys are thinking about taking on a new project, make sure you get in touch with our friends at Certain Lending and listen to all the great podcasts and webinars with slideshows that we've done with Nee and some of our other friends over at Certain Lending. Maybe they invest their funds with you guys, Tom, and we don't know it. I'd say there's a lot of investors out there that probably do invest their money with these hard money funds. And now you guys all have a due diligence checklist item when you're vetting hard money lenders to invest in their fund, right? As an investor with them, find out if they are, that's a safe way. Your money, in my opinion, is safer if you're investing your money with a hard money fund that invests in this infinite banking concept, right? It's another layer of protection for your money, right? When you say, Tom?
Absolutely.
What
totally.
a great due diligence line item, little nugget there, a little nugget bomb at the end for those of you that like to spread your investing around. Right? If you guys don't understand what I meant by what I just said, come see me on a Thursday and I'll tell you more of what I mean. But other than that, Joe, and remember, everybody go check out Tom's website, which is stressfreeplanning.com. And Joe, take it home.
Yeah, so you can find all the show notes at seattleinvestorsclub.com/144. That's seattleinvestorsclub.com/144. And if you're watching this on YouTube, we love a thumbs up if you liked it and a subscribe if you really liked it. So, and I was going to ask Tom, and a comment. Yeah, absolutely. And Tom, is going to your website the best way to get in touch with you?
Yeah, so I have a very simple method of education, and that is if you go to my website, you can put your name and email in, and that gets you access to my video page. I don't put my videos on YouTube. That's the only way to get access to them. And so you put your name and email there, and then you get signed up for a video page. And then from that video page, there is a way to contact me and get a one-on-one meeting where I can explain to you exactly what you can do personally.
Good stuff.
Yep.
Right. And if you need a little sound mixing, you might be able to hire him as a side job. Who knows, right?
Oh, yeah. I'm always available for that.
Right on. Well, thank you, guys. This has been a good one today. Super informative. And we have just got the tip of the iceberg here, I think, on this topic. So we'll be talking about it more, and we will see you guys all next time. Thanks for joining us.
Thank you for having me.
Over and out.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.